Okay, good afternoon. Assalamu alaikum. Um, okay, I'm about to start the class. Still, there are some students who are actually trying to enter. So, meanwhile, I will admit them as well and let me share the screen with you. All right, so we started the chapter Business Finance. Okay, in the last class, we talked about the difference between capital and revenue expenditure, the importance of finance as well, why finance is required for businesses, and then we talked about working capital as well, why it is very crucial for every business, the importance of working capital cycle as well. We discussed it. The okay, and then we discussed how we can manage working capital effectively so that business will be able to meet its expenditures, be it capital expenditure or revenue expenditure. Okay, we started sources of finance in that class as well. So, internal source of finance, retain. Okay, we talked about retained profit, sale of non-current assets, sale of stock or inventory, personal savings. We discussed about it. Okay, internal sources of finance. Okay, external sources. So we were discussing that. Sorry. Okay, just let me see whether is there any other student who actually. All right, let me see how many. Okay, Taiba is there. All right. Okay, it's almost 10 minutes past 12. So I think this that should be it. All right. So we talked about bank overdraft. Okay, bank overdraft. We discussed about it as well. It is a facility given by the bank to its account holders, right? To withdraw money more than the amount which is there in the account. Okay, and I told you earlier that the advantage is that it is quickly available, right? So, and you know that when you require finance quickly, it is for revenue expenditure generally. Okay, uh, and sometimes for capital expenditure as well. But you know that for capital expenditure, it's a long run expenditure actually. I mean, like you need to buy a machinery or building, okay, or stuff like that. But for revenue expenditure, you know that you cannot actually delay that expenditure. I told you earlier, like you cannot delay paying your wages to your workers. You cannot delay payment of raw material to the supplier. You cannot actually delay paying the rent of the building. Okay, so here bank overdraft will be extremely useful because it can be quickly arranged. And but the thing is that you need to pay it back along with the interest rate. So it's not only about the original amount you will pay it back. It's actually the amount over and above the amount you actually took from the bank. That is what we call interest rate. So if you actually borrowed 2,000 over and above than the amount you had in your account earlier, let's say 10,000 was the amount in your account, and you actually borrowed 12,000. Sorry, you withdrew
सर
12,000. Yes.
सर एलिजा यासिन को प्लीज ऐड कर लें.
All right. Let me see. So, okay, it's actually 12, so you need to be on time, right? Yeah, now it's 12:10. So now, after that, I'm not going to admit anybody. That is it. All right. And let me see how many students are there. Just a minute. Okay, all right. Um, so now, so you now understand the advantage or disadvantage of using a bank overdraft as an external source of finance. So it means you have to pay more amount than actually you took from the bank. Like for example, you have $10,000 in your bank account and you actually able to withdraw, let's say $12,000, so 2,000 extra. Now you won't pay 2,000 back to the bank because obviously the 10,000 was the money which actually belonged to you. Okay, so you do not need to pay it back. But what about the 2,000? You have to pay it back along with the interest rate. So you may have to pay $2,200 or $2,300 now. So that
सर
is
बिजनेस
actually
फाइनेंस करें हम टॉपिक
yes, 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 yes.
चलिए ठीक है
That's
सर
right.
थैंक यू
Okay, so it means interest is an extra expense. Sorry, is an expense, right? And when expense will increase, it will reduce the amount of profit for the business. So that is one of the drawback of using bank overdraft. The second external source of finance is trade credit. You know about it, I guess, as well. So trade credit is when you actually buy goods, but you do not pay for it immediately, and you actually ask for a certain time period. Okay, it can be 2 months, 1 month, or 3 months. So again, it is a kind of a finance. Why? Because the amount which you were supposed to pay to your supplier for buying that raw material, or for buying that number of products, you are using that, or sorry, you can use that amount for your business purpose. So that amount, obviously, you were supposed to pay to your supplier, but you will not pay it, you will delay it, and you will pay it after 2 or 3 months. So now this amount is available to the business, okay, for meeting certain expenses for those couple of months, right? So this is actually a trade credit. So yes, it is an advantage. You again, but the problem is with this method of finance that it's not actually um, a source where you can generate a large amount of finance. If you delay paying to your supplier, obviously that amount will be a very small one, okay, and you can use that to meet your revenue expenditure, right? Because normally revenue expenditure, in case of that, the amount of expense is relatively small, so you can use it. But if you actually want to expand your business, or let's say you are going to take over another business, so that requires a huge amount. So the amount of trade credit might not be enough for you at all. Secondly, if you go for that trade credit, you will not be able to avail cash discount. Now, what is cash discount? Cash discount is when you pay cash, okay, for the goods you buy. All right. So what actually the supplier does, they they normally offer you a discount, a reduction in the price of the product. But because you do not pay on the spot, that's why you miss out that discount. Because if you avail that discount, it reduces the cost of the business, because now you will get the goods cheaply. But because you are actually availing trade credit, so this option is not available. You cannot reduce your cost, and you have to pay the same price to the supplier. Okay, so there will be no reduction at all. So that is one of the disadvantage of using trade credit there. Then we have debt factoring. So you need to understand it as well. What is debt factoring? Debt factoring, basically, a factor is a specialized agency. You need to understand a specialized agency. Now, the question is, what is the job of that agency? Actually, that agency buys the debts of the company or the business. Now, let me give you an example. For example, um, I have sold goods to a person. Okay, let me just demonstrate it to you so that you will be able to understand it in a better way. Okay, just a minute. All right, so I hope you can see the screen as well. Let's say there is a person A. All right, so that person actually sells goods, okay, of the value that is, let's say, $1,000, for example, okay, to another person, okay, and that person is B, right? Let's say. Now, okay, so that person actually buys the goods, buys buys goods, okay, but without paying cash. Remember, and why cash is not paid? Because that person will pay it in the future. So buys goods without paying cash with a promise, with the promise to pay it at some future date, right? And obviously we call that person debtor or trade receivable. You know that this person is actually the debtor, or another word we use, trade receivables. Okay, we call it in accounting terms as well, and we will discuss that in the coming chapters about it as well. But it means that the person owes money to A. Okay, debtor means, let me just use the arrow there so that you can understand. Debtor basically, or trade receivables means person who owes money to business. That means the person is supposed to pay it back at some future date, right? So this is how, let's say, if this is then the case, okay, you sell goods for $1,000 and the person buys it but does not pay cash, right? Now, for example, and how much time period was given? Let's say the time period which is given to B, that is, let's say, 2 months. That after 2 months, the person will pay the amount back to A, right? Now, after 1 month, let's say after 1 month, A is direly in need of cash, in need of cash. That A requires cash immediately to meet its expenses. Okay, so let's say is after 1 month, A is in need of cash. Now A cannot contact B. Why? Because if A says to B that okay, please give me the amount, give me my amount, so B will say no, I will pay it after 2 months because still the time hasn't passed. So I am not supposed to pay it back after 1 month. Now there is a problem because A needs the amount, that is $1,000, to meet its daily expenses for whatever reason. Now what will happen? That A will contact another party. Okay, because yes, that is for sure that B will pay after 2 months. But right now the expenses cannot be delayed. I'm telling you, and there are certain expenses which cannot be delayed. I told you earlier, like there are many revenue expenditures. I just explained that workers are waiting for their wages to be received, and right now the business does not have sufficient amount of cash to pay to workers at the end of the month. So there is a problem, and you cannot delay it. Otherwise, workers will stop working, right? So A will actually contact who? Factor. Okay, A will contact factor. Now, what is a factor? Factor is basically an agency. Okay, let me just use a box with it now. What is actually a factor? Let me write it there. It is an agency or a business, whatever you say, because it is a business as well. It is an agency which buys the debts of the company, of the business, कह देते हैं. All right. It is an agency which buys the debts of the business. Okay. Now, what does it mean? It means that now when A will contact factor and will say, I am in need of $1,000, and that is the case that I have sold goods to B, and but B is to pay it to me after 2 months. But I am in need of cash right now, soon after a month. That is my problem. So factor can resolve that problem. How factor can resolve that problem? Factor will say that okay, I will pay you the required amount of cash right now, okay, to meet your immediate needs. Okay, this is possible. This is what is done by the factor. Okay, so factor will say, let me write it there, will pay the amount, or let's say the required amount. Factor will pay the amount right away, okay, on the spot. Okay, but the thing is, factor will, now obviously the A will be relieved from the tension that okay, at least I am getting the money which I require. But the problem is, factor will not pay $1,000. Factor will pay $950. Now, why factor will pay $950? Because the difference of $50 is the profit of the factor. Because now factor is taking the risk of collecting money from B. Because later on, who will collect? Factor will collect from B, right? Remember, factor will collect the same amount from B, okay? And that amount obviously will be the same, that is $1,000, okay? This is how it works, okay? This is the mechanism of that factoring. But now 950 means $50 will be the profit of the factor. So A will feel relieved because now A can use that money, even if the amount is not $1,000. Still, A will feel relieved that okay, now I can pay wages to the workers and I can continue with my production process. Okay, so this is done this way. But for that, what is required, that A will actually provide the invoice to the factor. Now, you know what is the invoice? Invoice is actually the bill which has not been paid yet. Okay, invoice, because invoice basically shows that this is the person who is going to receive the amount. Okay, so invoice is actually given to the factor, and then factor presents that invoice. Listen, okay, factor presents that invoice to B, and B understand that okay, now I am supposed to pay it to the factor rather than A. Okay, now there are advantages there of using this source of finance. Although again, not much amount can be raised through it, but again, to meet your revenue expenditure or to have sufficient amount of working capital, as we discussed in the last class as well, this is very important, and you can be able to meet your revenue expenditure. Okay, now the advantage is, yes, you can get the cash immediately. Okay, the finance you require, it's fine, right? Now, second advantage is, you are relieved from collecting money from B, because you know that lending money or giving money is very easy, or giving a facility to someone is easy. But when it comes to collecting the money back, it's not that easy, because the actually the other party can use delay tactics, or can say okay, I'll pay after a month, or maybe give me some more days. Okay, now A is relieved from it. Why? Because it is now the responsibility of the factor, okay, to collect money from B. Okay, so again, another advantage is there. But the disadvantage is, as you can see, that whole amount is not received. So actually, $50 will be deducted by the factor as the profit of the factor. Otherwise, why would factor provide the facility, that finance facility, to A? Obviously, there needs to be a certain objective, and objective is to earn profit. So $50 is the profit of the factor. Okay, and so the whole amount will not be enjoyed by A if this source of finance is used. So this is debt factoring, and I hope that everybody understands that. So anybody who is still not clear, I am there to answer. So you all are clear? It means that there's no problem. All right, Zain, is that clear to you?
Yes, sir.
All right, okay, moving
Sir,
forward.
isn't
Next,
this a loss to the isn't this a loss to the party A? I mean, first he helped the party B, but then after all, he has to face loss. Like,
Ramin, listen. Actually, we can't say it a loss, but yes, you can say that party A will lose a certain amount of money, because loss is something different. Because when we say loss, it means that the expenses are greater than the amount. Sorry, you are getting, right, as revenue. Like for example, whatever you are selling and the amount you are getting, the expenses are more than that. We call it loss. But here, yes, you can say that this is the loss of money. Definitely, business A will lose money that is equal to $50, but it is not actually a loss. Remember, because loss has a different definition. Ramin got
All
it?
right, sir. Yes, sir.
All right, thank you. Now, moving onwards, the next is hire purchase and leasing. Now, you need to understand it very carefully. There is a difference. Although you know that it's leasing is a very common term, okay, which we actually use on daily basis, and we know that what is leasing. But sometimes some people they are not very clear about it. So let me tell you. In both cases, let me tell you about the similarities both types of source of finance they have. What is it that in both cases you start with an initial down payment? Now what is it like? You do not need to pay the whole amount of cash, or maybe the equal to the total value of the goods. Okay, let's say the total value of the goods or of the product is $2,000. Okay, so now you do not need to pay it, I mean the whole amount. But you pay 20 or 30% of the original amount. Okay, so obviously you will pay sorry, you will pay 20% of the original amount, okay, on the spot, and rest of the amount will be paid in installments on monthly basis. So it becomes very easy for the business to use that asset or product or equipment, machinery, building, whatever it is, vehicle, because now, and it is extremely useful for those businesses who do not have sufficient amount of cash to buy an equipment, machinery, building, vehicle, whatever. Okay, so they can start with by paying a very small amount, that is 20% of the original amount or 30% of the original amount, and the rest of the amount they can pay it in installments over a period of time. And you know that when, for example, some business buys an equipment and they use it to produce items, and later they are able to sell it as well, so they get a certain amount of revenue as well. So it becomes very easy for businesses to pay the installment out of that revenue. Okay, so that is why it's a good source of finance. Either it is hire purchase or leasing. So in both cases, you do not pay the full amount right away. You pay a certain very small proportion of the total amount. Okay. Secondly, um, so that is what we call down payment, which the amount you pay first. Okay. Along with that, what do you do along with the installments? You have to pay an interest rate as well. So that is a disadvantage as well. Like for example, a vehicle whose cost is, let's say, $20,000. Okay, so you end up paying $22,000, and why? Because the extra $2,000 is for the interest rate. So that is actually a disadvantage as well. That if you use this source of finance, you actually pay more than the actual amount of the equipment or vehicle, whatever it is. So in both cases, either it is hire purchase or leasing, interest needs to be paid along with that, along with the installments. Okay. Now let's talk about the difference. Difference is in hire purchase, as you can see that the name purchase is there. So you actually, this is a contract of purchase that you actually have an intention to buy it. So you make the down payment, that is the 20% of the total amount, and you take the possession of the good, and now you are the owner, right? Now you are the owner, okay, because this is a contract of purchase, and you start using the product. Let's say it's a vehicle, or it's a machinery or equipment. Okay, now you start using it, and you start paying the installments along with the interest rate as well. Whereas if I talk about, and obviously when you pay the whole amount in installments after a certain period of time, so obviously now there is no responsibility as far as your business is concerned. Okay, because you have paid the full amount. It's easy to understand. But when it comes to leasing, you know that generally what is done through leasing, cars. I mean, normally we say that I have bought car on lease. This is a wrong, uh, uh, absolutely wrong to say that, because through leasing you cannot buy anything. Leasing is actually a concept of taking something on hire, and you actually have the liberty to use that product, but you do not become the owner. Remember, in hire purchase you become the owner of the vehicle or of the equipment, whatever you actually buy. But leasing is a concept where you actually uh, take it on rent. So you take the possession and you start using it, right? This is leasing, and you pay the installments and along with the interest rate. Now, let's say if you stop making payment, remember, if you stop making payment, especially in leasing, they take away the good from you. Simple as that. Okay, and I'm telling you, I know many people about that. They actually give you first warning, second warning, third warning that you are not paying your installment, and then they may stop you right on the road. I'm telling you. Okay, they will ask you to get out of the car and please hand over the keys and the documents uh, to me, right? Yes, and you cannot do anything because you are not the owner. When cars actually are taken on lease, you can't say cars are bought on lease. Cars are taken on lease. Okay, okay. So ownership is not transferred. Okay, ownership remains in the hands of the banks. Okay, so it means that you cannot sell the car even as an owner, but you can become an owner at the end of the time period. And what does it mean? If you keep on paying the installments and finally you decide that yes, I want to buy it as well, then you make the full payment, and then banks normally um releases a document or a letter, that is what we call no objection certificate, NOC, that now we have no objection. Now the property or the car or the equipment belongs to the person. Now he or she is the owner. So this is how it is done. But in hire purchase, obviously you are the owner. Yes, they can file a case in the court against you if you do not make the payment. But now you are the owner of that equipment, right? But in case of leasing, they can take away. You cannot even go for legal proceedings in the court because you do not own it. You just hired that car, and for that you were paying the rent of that car on monthly basis. This is leasing all about, right? But you can decide to buy that car as well at the end of the time period when you make all the payment, and banks uh, give you NOC. So this is how it is done. Now, any question regarding the difference between hire purchase and leasing? Any confusion? So there is none. It means that you are absolutely clear. So there is no issue at all. All right. Bilal Jamil, is it okay?
Yes, sir.
All right. So now the the advantage is similar in both cases, that you do not have to make the whole payment, despite paying a very small amount of the total value of the asset or the vehicle or the car. You are able to use it. Okay, and you can continue your production. Fine. Okay. But the disadvantage is you have to actually pay more than the actual amount or actual value of the asset or the product or the good, whatever you are actually using. So this actually increases the cost of the business and reduces the amount of profit as well. Long-term bank loan, you understand that you can get a certain amount of money from the bank, but it is long term. It means you might have to pay it after 10 years. Normally, it is taken, like for example, for house building, you can take a loan from the bank, okay, for 10 years, let's say, and obviously you will pay it in installments along with the interest rate. So again, the disadvantage is that you have to pay the extra amount in the form of interest rate. So but there is actually an advantage that you have to pay it after a very long time period. So you can use it for setting up a new business or a building, okay, because you know that you will be paying it after some time. So you can set up your business, you can start your production process as well, and you can sell it as well, and later you can pay the installments from the revenue you will get from the sale of the product. So it becomes quite easy to pay it back because long time period is there, and meanwhile you can generate lot of profit and revenue as well. So this becomes easier. All right. So but fairly large amount, in fact very large amount, can be raised with the help of long term bank loan compared to bank overdraft, trade credit, debt factoring, hire purchase and leasing. So long term bank loan can raise very large amount. So it means that you can go for capital expenditure as well, because you know usually capital expenditure requires a large amount. But again, another disadvantage of long-term bank loan is you need to offer a security as well. Security means that obviously you are taking money from the bank, so bank actually requires some kind of assurance that you will pay it back, right? So for that, they take the documents of your property, let's say, or any of your asset. Okay, they take it away. And now, okay, why they take it away? Because if in case you are unable to pay, they will sell it off to recover their amount. So now there is a problem. Problem is, for example, you want to sell your asset, okay, or sell your building or land or whatever. But now you cannot sell it. Why? Because now it is in the possession of the bank. Okay, so despite being the owner of that item or that good, you cannot sell it because you have given it as a security. And the word used for it is collateral as well. COLLATERAL. Collateral is another name given to security. So this is again a disadvantage, and some businesses might not have any security to offer. They do not have any such assets available. So again, it might not be available for small businesses because small businesses cannot offer security. Okay, and remember, whatever is offered as security, only 60% of the value of the security is given as loan. Like, for example, you offer a security whose value is, let's say, 20 lakh. Okay, so they will actually offer you only 12 or 13 lakh or maybe 14 lakh at the maximum. Do you know why they actually offer you a less amount compared to the value of the security you offer? The reason is because so that you will pay it back as well. Because if the amount is the same, you might not pay it back. You will say, all right, you can take my property and I won't pay. So banks, they cannot do it. Why? Because then they will be involved in selling the property and they cannot focus on their main business, that is receiving deposits from the people and lending money to the people. So they can't do it that they start selling properties of of their customers to recover the amount. This is just not possible. That's why they only offer 60 to 70% of the value of the asset which is offered as a security. All right, then moving onwards, debentures. Again, you
सर
understand? Yes, please.
सर कोलेटरल जो है वो किस तरह एक फॉर्म है सिक्योरिटी की इज इट एन एग्रीमेंट और व्हाट
No, actually, what happens? You either submit documents. Okay, for example, you have a factory, so you can actually offer the documents to the bank that okay, you can take away our documents. Okay, so it means that now you cannot sell your property. Why? Because obviously, to sell your property, you need documents, and if documents are in the possession of the bank, so obviously you cannot sell it. So this actually gives assurance to the bank that yes, we are safe. And even if they do not pay, they cannot sell off that particular asset. So we will sell it off if the amount is not paid at the right time. Got it?
यस सर
All right.
थैंक यू
Okay. Next is debentures. Now you need to understand what is a debenture. Debenture is basically a certificate, right? Okay. It is quite similar to shares, but it is different from it actually in every way possible. Debenture is, for example, you want to raise a certain amount of finance, okay, but you do not want to issue shares. Now you know that because issuing shares means you are actually admitting certain people as owners, because people who buy shares of the company, they become shareholders and they become the owners of the company. So in that way, profit will further be divided among more owners, and maybe the existing owners or shareholders, they do not want it to happen. So for that, they do not use that source of finance, that is issuing of shares. So rather they issue debentures. Now what is a debenture? Debenture is actually a piece of paper, a certificate, which actually tells that the person who is holding that has given a certain amount of money to a business, right? So that person is actually becomes a lender, and we can say debenture holders are the creditors of the business. It means yes, debentures are available in the stock market as well. So if you buy debentures of a company, you become a debenture holder, okay, and you receive a certificate, that is what we call debenture certificate. So if we define debenture certificate, we say it is an acknowledgement of a debt. Now, what does it mean? That the business actually uh, confirms that you have given a certain amount of money to business, and business is responsible to pay it back after some time. Normally, it is more than 10 years. Okay. So, and now you can keep that piece of certificate with you. Okay, and this guarantees that you have given money to the to the business. Now, obviously, the value will be written on that piece of paper along with the stamp of the company, with the signatures of the management as well. So you can keep it with you. Now, so it means that what is the point of buying debentures? Now, the incentive is when you buy debentures and you become debenture holders, you do not only get the money back, you actually receive interest rate along with that as well. So companies or businesses, they offer that as well, that people who buy debentures and they become debenture holders, they will receive a certain amount of interest, okay, on annual basis, okay, it can be on monthly basis as well. So this is actually an incentive for debenture holders. Now, a fairly large amount can be raised with the help of this, because normally they are paid after 10 years. So again, you can use it for a capital expenditure as well, or for the expansion of the business as well. But again, the problem is because you have to pay interest rate, so interest is an expense, and expense reduces the amount